Ashish Gupta joins us. Let's take a conversation forward. Ashish, good morning. Thank you for joining us. You
Hi.
have to observe a 2 minute silence these days before you start talking about markets, right?
Yeah. No, I think we should actually look at the underlying data, right? And I think it is quite clear that data is starting to improve, right? Whether you look at the market data, you look at some of the numbers that you guys have been talking for the last 10 minutes. And so I think we should not be too pessimistic at this point of time. If you see the December quarter GDP, it came in, there was a sequential improvement compared to September of nearly 60, 70 basis points. And clearly, it looks that the March quarter will be a further sequential 60, 70 basis points improvement. Right. In fact, the government estimate is of more than a 1% improvement, nearly 7.5% GDP growth for the fourth quarter. So I think we have to take cognizance of the fact that the economy is bottoming out. And I think that is really the message for the market also. So if the economy is going to bottom out, I think we should expect the markets should also find a support. I also don't think there is a huge amount of leverage or accidents waiting to happen in terms of either corporate balance sheet or the banking sector balance sheets or even the leverage levels in the market. So I'm not really very pessimistic at this point of time. Of course, there are a lot of global uncertainties that are still out and about. But I think I'm more positive on the markets compared to a couple of months ago.
Interesting you say that, Ashish. But what about that one focal point, earnings? Do you think that's going to make a comeback or not?
So I think at least the expectations have already moderated. So what we saw actually from middle of last year, while the earnings growth was starting to slow down, the market expectations were still elevated. And again, this quarter earnings growth, December quarter, was not much better than the previous two quarters. So it was around mid-single digit, but it was largely in line with expectations for the quarter. But we, of course, did see moderation in commentary of corporate India, and we have seen a significant cut in FY26 earnings. So FY26 earnings that 6 months ago people were forecasting at about 18% growth, that's moderated to about 12, 13% growth. So I think the scope for earning disappointment has significantly come down. And that's why I think really the fundamentals of the market are looking better than when they were 6 months ago. I am, of course, believe that it's not going to be easy to get back to the 18-20% earnings growth very quickly. There are still challenges. So if you see the data coming out, several data, whether it is auto sales, GST, even power demand growth. So all of those have turned more positive. So even for this month, power demand growth was about 7%. So these have turned positive. But if you see some other indicator, that still continue to be lukewarm. So credit growth month on month for February was still only about 0.7%. YOY, it was about 11%. So we need a broader recovery in the macro data to really go back to that 18-20% earnings growth.
Ashish, that is lack of disappointment, which I agree would be enough trigger for the markets. But where do you see earnings upside coming in? Where's the capex? Where's the cash flow? Or do you think it's going to be very, company specific this time, as opposed to more sectoral and broad based, as was the case, up until October last year?
Sure. So I think you're right. A lot of the thematic top-down may not work as well, and you will have more bottom-up confidence in company earnings that is going to start to play through. But we have to be cognizant that many of these companies where there is more visibility on earnings and earnings growth continue to trade at fairly rich multiples, right? And so whether it is the EMS companies, whether it is select industrial companies, real estate companies, telecom, you do have better visibility of earnings growth, but again, the multiples are not cheap and they are still elevated compared to historic level. So you need to, in this kind of market, balance out the earnings visibility as well as really the multiples that some of these names are at.
Hi Ashish, this is Shrishti also joining in. But Ashish, in this recent fall, help us understand that any changes that you have made in your portfolio, because we do see that you have exposure to some of these beaten down sectors like jewelry, defense, renewable capex. So help us understand that any particular pocket that must have looked attractive to you and where you have gone ahead and increased your exposure.
So I think we have been fairly disciplined or even over the past year in terms of our kind of allocation across market cap cohorts as well as some of these top-down thematic investing. I think we were quite clear that thematic investing is really not going to change. I think the bigger sectoral changes we have made is we have increased allocation to financial services. We have increased allocation to healthcare. We have in some of the consumer focused sector doubled down on stock. So while we may not have changed the overall allocation to the sector, but we have kind of really looked at companies which have been delivering compared to companies that have not delivered. So there has been some of churning within our consumer exposure.
All right, but specifically, Ashish, talk to us about the defense pack, though the outlook, the kind of order book that these companies have, they still look robust, but there are concerns on the valuations. What's your say on that? And recently, given the correction, any particular pocket that is looking attractive to you?
So I think on the defense pack, the valuations have started to kind of look attractive. There are though question marks on the delivery timelines and really order book to revenue conversion that some of these companies are being able to deliver. So I don't think valuations really are a challenge. I think compared to the opportunity that is there and relative to where the rest of the market multiples are, I don't think necessarily defense multiples are the issue. I think we need to be more confident about order book to revenue conversion that some of these companies are going to be able to deliver. And I think if we get that confidence, there is certainly a scope for bounce back, if not in the entire pack, but at least in select names.
Talk to us about the PSE pack, because nobody is actually talking about those stocks, that sector, of course, because they were the darlings in the first half of calendar year 24. But look at the correction in the second half, and now the correction continues with even sharper cuts. So do you believe that it's once again time to maybe look at some select opportunities within that? And if yes, then which are those?
So I think at this point of time, we are most excited about the PSUs in the utilities space. I think there the confidence on earnings and earning stability is maximum, and valuations, as you mentioned, have become quite attractive. So they are now down to about 11, 12 time earnings multiple from 18 to 20 times earnings multiple. So given the kind of growth visibility that is there, I think PSU utility names look attractive to us. We have seen many of the other PSUs, including PSU banks, their multiples have also come down back to about one-time book. So they look okay, but again, they have started to lose some market share on the deposit side. And again, because the private bank valuations are also quite attractive at this point of time, we continue to prefer private banks over PSUs, but PSU bank multiples are also now quite
Ashish, before we let you go, quickly, if you can highlight some of those sectors you believe that the challenges will persist, because there's been lots been happening with respect to the global and the macro front. So help us understand that any particular sector you believe that could underperform in this particular year.
Sure. So I think we have to be really quite watchful on what is going to happen on the tariff front. Many companies and sectors in India, either because of their exports or more importantly, even if they were selling in the domestic market, have had strong margin accretion over the past 4 years because of tariffs that we enjoyed. And I think it is not certain where all we will continue to have this kind of tariff protection. So I think we have to be focused on many of the commodity-based sectors like metals, global commodities, whether we will be able to have the same kind of margin tailwinds, or actually we might get headwinds on the margins over the next 6 or 9 months if really the tariff patterns globally change. Simultaneously, even for some sectors like automobiles, as well as generic pharma, we have to be cautious of what happens on the tariffs, and particularly US tariffs.
If you like this video, then like, share and subscribe to ET Now.